Reading some comments in that last segment at the end from one of the leaders of one of the largest institutional money managers in the world. And I want to just recap that last sentence that we were saying before the break. These are his words, not mine, but obviously we echo the same sentiments. A recession is necessary to clean out the excesses of the past decade. You can't have a sustained period of growth with an occasional downturn. It's part of the economic cycle that's been going on for 100 years to balance things out. It's normal, it's expected, it's healthy. Now, what's it mean for investors? Well, it's impossible to predict because of how that cycle moves and moves very quickly. So there's no way to really time it, but the better approach is to participate in maintaining a balanced, well-diversified, all-weather portfolio. The kinds of stuff that we've been talking about on this program for 30-odd years, and through that we've seen how many recessions? 4, I think, if we go back 30 years. So it's a formula that kind of works. On the positive note, though, we've got some interesting stats that we want to share with you, as we did at the beginning of the week with our clients, that might help to give some perspective on that. And I think the first one is what we were saying a little bit in the last break. Look, if the market's down 24%, what do you think that's priced in? Has it priced in maybe already a recession? Maybe it's saying, hey, we're already in a recession. One could argue that with 2 quarters in a row of negative GDP growth at the beginning of the year, Q1, Q2 of this year. Or is there one immediately around the corner? Who knows? Clearly, if the market's down 24%, it's priced in something already. And I guess that's the key point. A lot of people, when you go through a period of time like this, say, it's going to just keep going down. There's not going to be an end. And that's not how it works, because eventually the market sees, okay, the next part of the cycle, which is the recovery part, and says, all right, well, we'll start kind of moving up here. And the thing that people forget is that concept we were talking about in the last segment. The market's looking out 6 to 9 months. So if you're looking at today's headlines, guess what? Market's already kind of priced that in already. What does the future look out 6 to 9 months? Okay, well, you've got all those interest rate increases that have now had their impact, and in theory, they've had that impact on inflation. And so perhaps now, thinking 6 to 9 months, okay, maybe the Federal Reserve can kind of pull back a little bit on its approach. Of course, stay tuned on that. That's why we do the show every week, because the markets change every week. But we want to leave you with sort of 3 other sort of stats, if you will, in this conversation. And the first one is one of the ones, well, all of them are ones that we pointed out to folks in that communication that we sent out on Monday. The reality is that there's a kind of a misnomer that when you have rising rates, that it's not a good period of time for market performance. And not to say that it's a great period of time, because obviously rising rates are intended to sort of be a drag on the economy, but it's not an awful period of time. Because if you look at the past 8 rate hiking period since 1977. So basically over the course of the past 40-odd years, there's been 8 different periods where we've seen the Federal Reserve raise rates. Why? Well, because that's part of the economic cycle. There's been 7 recessions, 8 expansions, 8 different periods of rate hike. I mean, you get the point. There's a certain cycle to all of this. Interestingly, if you go from a period of time when those rate increases started to 1 year out, you'll find that over those 8 previous times, average return is close to about 13%. So there's definitely not quite reason to sort of throw in the towel completely if you're in an environment of raising interest rates. I want to give you 2 other statistics, and these 2 I think are equally important. First and foremost, if you look at midterm elections, in case you forgot, we got one coming up in about a month. The reality is that going back to 1942, in the midterm, every midterm period, meaning the year that immediately follows the midterm election, if you look back to 1942, every year it has produced a positive return, the average of which is about 15%. So some interesting data on midterm elections and what happens once you get through that threshold of that midterm election. Similarly, if you look at investor sentiment, and this is one that I kind of always like to look at because it tells you a little bit about how people are feeling. Well, guess what? With that big of a decline in the first 9 months of the year, right? The biggest decline that we've seen since 2002, so 20-year period of time. As you might well imagine, people are relatively negative. And in fact, investor sentiment at the lowest level that it has been since March of 2009. Well, if you check your market history books, you'll find that, wait a minute, March 2009, that was sort of the turning point of when the recovery began post-2008. So obviously, time will tell. We got some interesting stats, if you will. We'll see if investor sentiment in midterm elections continue to sort of be the turning points or the potential for turning points that we've seen certainly in previous years. So stay tuned on that. Clearly, it is a time where inflation is first and foremost, and it is certainly having an impact across the board. That's one of the reasons why this coming week, actually, we're going to be doing a sort of a meet and greet luncheon seminar at our office in Winter Park. You get to see our little expansion, and we've got a good-sized conference room with that expansion, so we're going to be doing a sort of a meet and greet. Haven't done one of those in a number of years because we were kind of cramped at the office, so hence that addition of the additional space. And so we're going to be doing a meet and greet, but more importantly, a conversation about how you fight inflation and how you deal with inflation as an investor. So we got some interesting stuff to be talking about. That luncheon seminar is, of course, open to everybody. But particularly, it is sort of a meet and greet, an opportunity. If you've always thought, hey, you know what, I listened to this Joel guy on the news, on the radio, on and off over the course of the past 20 plus years. Before that, it was his father-in-law, Jack Nelson, and you know what? I want to go and meet these guys, or I want to go and check out the rest of the team and just give an opportunity to kind of meet us and put a face with the name, if you will, or put a face with the voice on radio or on our podcast channels. And there is an opportunity for that. So the date is October 13th. So that's coming up this week. Let me just check my calendar as to what day of the week that in fact is. That's a Thursday. So that is coming up on Thursday. So hopefully you can make it. If you'd like to join us for that, then simply go to our website, nelsonfinancialplanning.com, or you can call the office 407-629-6477. That's how you can register for that event. Speaking of the website, of course, as you know, the radio program is also a podcast, one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel of choice, because in that way you can find our program and know when it gets uploaded. We also upload different stuff throughout the week as well. So changing gears a little bit, we all know, as we've just discussed, 2022 has not been a particularly great year for the markets. Well, that translates into issues for pensions funds, but the worst on that may yet to come, because a lot of those pension funds, for example, the biggest one here in the state is the state of Florida pension fund that manages about $180 billion in its pension fund. A lot of those funds have yet to sort of price in the damage from the illiquid part of their portfolios, private equity, real estate, things like that. It takes a while to get accurate pricing on that versus, say, 100 shares of Microsoft. So the decline in the private equity or liquid investment type side of things takes a while to price in. Well, part of that, though, combines with a trend that pension plans got more involved with that stuff seeking additional return. So when we return, we're going to talk a little bit more about this topic and how it might very well impact your pension plan. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning.